Daniel Shaykevich, good morning. Thank you for being with us on Capsule.
Thank you for having me in beautiful Geneva.
You are Senior Portfolio Manager at Vanguard in the active fixed income team. So your expertise is in fixed income, and we're going to talk about it today. As we are all expecting central banks to cool down on their monetary policies, how declining interest rates on a global scale are going to impact the fixed income markets for the rest of the year?
Fundamentally, there's been growing concern that neutral rates have risen globally. So when central banks can actually start easing policy, it will be a confirmation that the current level of developed market yields is above normal levels and is going to support the valuations and the potential performance in fixed income globally. But it's also very important technically. So right now, if you buy a 10-year bond, whether it's in the US or in Germany, it seems like you're getting a very high yield, but you're actually under-yielding money markets of very short-dated debt. And that is preventing or discouraging a lot of investors from buying bonds out the curve. Once central banks start lowering overnight rates, it's going to unleash a lot of money that over the last 2 years has been sitting in short-dated funds. And that money can really overwhelm a lot of the other technical factors that are affecting bond markets. It can overwhelm government issuance to fund deficits. It can overwhelm quantitative tightening, and it can lead to very strong performance, not just in government bonds, but also in things like US credit or emerging market bonds.
Which key features make emerging bonds in such a demand these days?
So emerging markets is a very special asset class. Within US dollar asset classes, it's very unique because it has both duration and spread. So you have longer duration asset classes such as US investment grade credits, and you have high spread, high yield asset classes such as the US high yield market or the junk bond market. But very few asset classes combine both. The reason that's important is because when you have spread and duration, not only does the asset class carry well, you're creating income, but you can see substantial price appreciation during periods of falling yields. And those falling yields can come because the asset class is benefiting from tighter spreads, or it can come because interest rates are coming down globally. And both of these factors can be supporting the asset class this year.
As you're saying, emerging debt is such a complex, such a large universe. Which segments should investors focus on in particular?
So that's a very good question. And you do want to distinguish between local debt, which is the debt denominated in the currencies of those countries, from external debt, which is debt in dollars and sometimes in euros. And you also want to distinguish between sovereign bonds, bonds issued by governments, and corporate bonds, which are issued by corporations. So the most proven asset class within emerging markets is the external debt asset class. And that's where you have multiple decades of very strong risk-adjusted returns. And that's an asset class that every investor should seriously consider having as part of their fixed income portfolio. Local and corporate bonds are also very attractive sometimes. The local bonds really do give investors access to potential appreciation of the currency, potential growth in the economy in a more equity-like manner. But the problem is that there's not a lot of diversification within that asset class. You have certain segments of the market which have become harder to invest in, and simply there aren't a lot of large issuers of local bonds out there. And corporate bonds, while they can be quite attractive, don't have the same liquidity as sovereign bonds. Companies are smaller than countries. So we prefer at this time in corporates to really incorporate the corporate bond exposure into larger funds. So we're not relying on that segment for liquidity. And for local, we do see value in the asset class, but right now we see more value in the interest rate component, meaning we think interest rates in emerging markets will come down and come down faster than in developed world. And right now we're a little more cautious on the currency side. We think we've seen a lot of appreciation in EM currencies, and as those central banks start easing policy, they'll become a little bit less attractive.
Daniel, you have been covering emerging debt for more than 20 years. Broadly speaking, over these 20 years, how have you seen them transform themselves?
When I was getting started, the indices were very concentrated. There were very large percentages of the index that could be exposed to any one or two countries. And the biggest drawback of investing in emerging markets is that you are sometimes going to take a certain level of concentration. And when something goes wrong in one country, it can really hurt your portfolio. Now, over the last 20 years, though, we've seen a lot more entrants into the market. We've seen a lot of new countries issue debt. And what's really nice about that is that you have countries issuing debt that are on the risky end of the spectrum, that add more high yield exposure. But you also have a lot of countries, such as the countries out of the Gulf, that are issuing debt, in their case, to fund their long-term diversification from hydrocarbons. And those countries are AA or single A rated. So you have an asset class that has the full credit spectrum from AA to distressed, and that's as diversified as it's ever been, making it much less risky for investors to allocate more substantial segments of their portfolio without being exposed to something going wrong in any one market. And of course, the nature of the asset class, the fact that you do have all these different types of names, creates a lot of opportunity for our active management.
Daniel, thank you so much for being with us.
Thank you.
Thank you for sharing your expertise, and we hope to see you around very soon. Thank you for watching. I will be back soon.